This is Sky News Business, Australia's business channel. The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you. Now, Small Business Tuesday continues with Your Money, Your Call.
Welcome to this special edition of Your Money, Your Call from the Australian Stockbrokers Awards. It's a night where we celebrate the industry's best and exceptional and also raise funds for charity. I'm Julia Lee from Bell Direct and we have a special show lined up for you. Each segment will have some different panellists to answer your questions. Now the phone lines are closed tonight. Instead, we're answering some of the emails that you've emailed in during the week. My first panel tonight, I'm very glad to say, is James Wright, the Chief Investment Officer at JB Were, where there are $50 billion funds under management. It's also always great when you talk in terms of billions of dollars instead of millions. And we also have Frank Casarotti, who's from Magellan, $52 billion worth of funds under management there. So let's go straight to our first email. And our first email asks, can you advise why world markets, especially the US stock market, is going gangbusters while the ASX is still about 1,000 points below its peak, which was 8 years ago, and has basically gone nowhere since January? So James, we'll start off with you.
Hi Julia, how are you?
Good.
Look, I think a lot of it's to do with the composition of our market. When you think about where we were back in 2007, the previous peak, around at 6,800, we've fallen 1,100 points or so, therefore, since that time. And BHP is probably about a third of that. Now, BHP was about $45 back then, and iron ore was $200 a tonne, and oil was basically $90 a barrel. And now, BHP is down at $22. Iron ore's back at 52. Oil's back at the low 40s, 42, and about a third of that fall is actually BHP. And when you think about the composition of our market, we're very heavy in financials, very heavy in materials and mining, and quite short tech. And tech has been one of the sectors which has been really running hard.
Okay, so that's a good explanation. So we've seen a big fall in terms of commodities from those peaks in 2007. So I guess the question is, looking forward, do investors need exposure to the US stock market, European markets, the UK market, maybe even the Chinese markets rather than here in Australia? Frank, are you positive on Australia, or, should we look at other?
Well, the world is a pretty good starting point to identify investment opportunities. We're kind of agnostic in terms of exactly where the company is based, in the sense that if you find an outstanding business, whether it's based in New York or London or in Asia, for us it really doesn't matter. So it's really about identifying the investment opportunity, the investment thesis. And as James mentioned, the US in particular has had a terrific tailwind post the GFC. And that's been very much driven by, a number of things, and James talked about technology. Some of the best technology businesses are US domiciled, so that's been a terrific tailwind. But also too, if you look at the economy, it's structurally more sound than what it was going into the GFC. So unemployment's lower, housing's recovered, interest rates continue to be low. All those are pretty conducive environments for a market to do well, compared to the good old Aussie market.
So that sounds good, US, but when we have a look at the Australian market, where the housing market's probably peaking, are you less positive on Australia? Is that what you're saying?
Well, we don't specialise in Australian-based assets, so we're probably not the ones to talk. But obviously, if you read the papers, yes, it sounds and feels and looks a little bit like a bubble, and obviously the Reserve Bank is stepping in to try and deflate some of that hype. But James, I don't know, maybe you've got more comment on that.
Yeah, look, I guess from the Aussie market, we're actually underweight Australia just at the moment, which is a little unusual for us. And when we think about those sectors in the Australian economy, financials are about 35% of our market, and you think about what the regulatory environment for financials in our market. You know, we've had the bank tax introduced in August, and our bank shares are down about 15% on the back of that. If you just compare banks are up about 5% in the US this year, and our banks are down about 1.5%. So in the US, Trump is trying to free up the banks, get rid of the regulatory reform, and free them up to grow. And they've had a really strong return since the election in particular. Our banks have been struggling on the weight of political issues and public perceptions.
So that's quite interesting, because James, you set the investment strategy for about 210 advisors and portfolios. So just having a look at that short Australia position, is it solely on the basis of the financial sector, or has the resource space got something to do with it as well?
Look, I think a lot of it's to do with some of the comments that Frank made. Interest rates are still low globally. The Fed has now started to raise rates, but when you look at what's going on in Europe, the ECB continues to print money, Japan continues to print money, China has stimulated their economy last year and it continues to go quite strongly. So the rest of the world's actually looking in a reasonable shape. And when we come back to the Australian growth outlook, there's still a few challenges. We had the mining boom, which sort of gave way to the housing boom. Building approvals are coming off, construction's starting to slow, and we're waiting for infrastructure to really fill the space. And it's doing that in New South Wales, but the rest of the country is still a little bit behind. So we're a little bit more sanguine on where Australian growth looks like, and from a valuation standpoint, some of those shares are certainly struggling.
Okay, some interesting viewpoints there. And I guess just finally, Frank, before we go on to the next email, Magellan has built its business on the back of sort of global markets, and it's quite interesting what's happening globally at the moment. What's your favourite market?
Definitely, you look at our portfolio at the moment, it is overweight US domiciled, but that doesn't necessarily mean the companies in the portfolio are just US centric. So, for argument's sake, companies like Apple, Microsoft, they do business all over the world. They earn revenue all over the world. So whilst they're New York listed, they are genuinely global. And that's, I think a lot of your viewers are probably underweight internet, good quality, high quality, multinational, global opportunities. And I think, that's where some of the future lies for part of their wealth.
Wow, so some interesting viewpoints there, especially in regards to being underweight Australia and some of the international markets and what's happening. And I guess that brings us to our next email, and that's the panel's view on a good stock to buy medium to long term, avoiding large-scale exposure to China, seasonality, something that's established with some growth potential. And James, we might start off with you because you look at Australian stocks as well. Looking at something in Australia, medium to long term, not a lot of exposure in terms of China, but with that growth potential, what do you think?
Yeah, look, one little company that we really like the look of is Aconex. It's about $1 billion market cap. Now, it's a cloud collaboration software in the construction game in certain projects. It was a bit of a market darling last year. It sort of hit mid $8, $8.50 around that mark, and it's had a pretty tough 12 months to be fair. I think it was a low of $3 in sort of January, February on some disappointing earnings results. But it's fantastic software, great customers. It's about 40% of global share of that collaboration software. So, and from a valuation standpoint, it's currently trading about $3.80. So it looks a little bit rich compared to sort of domestic peers. But when you're looking at it compared to global peers, it trades on about 4 times revenue, whereas someone like Atlassian trades on about 8 times revenue. So, it's good quality software, good quality customers, and as more and more of that construction industry moves into the cloud, and think about the big themes, infrastructure theme, construction, residential construction offshore, I think they'll continue to do pretty well. Earnings growth of about 17% for the next 2 years. So, I think it's one of those ones where the share price could be a little volatile in the short term, but I think it's one where you're going to be a real global leader in that space.
Okay, so looking at cloud software in the construction space, the infrastructure spend that's happening globally should be a positive. But 40% market share, that's quite a lot. Do you see growth in terms of that market share, or just the market growing for a company like?
Well, I think there's 2 things. I think the market will grow, but also more and more of that project software will move to the cloud. I think a lot of the projects that are still being done are old school paper, trying to keep track of how a building's going or how a brand new piece of infrastructure is going. And I think there's two things. There'll be more projects on, and I think there'll be more of that services moving to the cloud. So I think they're in a pretty good shape.
Okay, and tech stocks have been quite volatile in the US as well. So I'm quite interested to get your view on a medium to long-term stock, looking internationally.
Well, a stock that you might have heard of, Julia, is a company called Apple. Apple Inc., New York listed, has a few $100 billion in cash sitting on its balance sheet. It has subscribers that are fast reaching 500 million users. And one of the things that we love about this business, because we sat on the sidelines for a long time thinking, is this Nokia or BlackBerry replayed? Is it just about the handset? And the short answer that we concluded was no. It's about the ecosystem. And one thing that we think Steve Jobs did very well was he built this beautiful walled garden, and he invited us all into his garden, and then he slammed the door behind us. And what I mean by that is we are at the mercy of his ecosystem. So we've got our photos, we've got our phones, we've got our emails, we've got messages, we've got music, we've got a payment system. And it's part of an ecosystem, and all our devices talk to each other.
So Frank, it's funny you say that, because I've been waiting till September for the new iPhone to come out, because my phone is out of memories, it's jam-packed full of photos and videos. Now, does your recommendation on Apple have anything to do with it being the 10th anniversary of the iPhone? Do you foresee a sort of jump in sales? Are other people also waiting till September?
Well, I must admit, it's less to do about the new phone sales. It's more to do with the propensity to upgrade existing users, and obviously, hopefully, some new users. But this is one of the most analysed companies in the world. And we were able to buy it at less than $100 about 12, 15 months ago, now trading at about $145, $150 a share. So it was mispriced by the market, and it's still, in our humble opinion, trading at less than the market multiple. So here's this fantastic business with growth profile for many, many years to come, that is actually trading at a discount, and even less of a discount or even a greater discount once you strip out its cash holdings.
Now, we've got less than a minute left, but James, given that Frank's pretty keen on Apple and there's a new iPhone coming out, do you think that Australian retailers will be beneficiaries? JB Hi-Fi, Harvey Norman, maybe even Telstra? Yeah,
look, obviously I think the replacement cycle will help those retailers, but it's fair to say that those share prices have been under a fair bit of pressure with the introduction or pretending introduction of Amazon. And I think from a valuation standpoint, just on the JB Hi-Fis, it looks pretty cheap to us. You could probably dip your toe in just a little bit and wait to see what really happens when Amazon comes in. But I think they'll benefit, but I'm not quite sure it's going to be quite big enough to sort of change the share prices just yet.
Well, we're out of time for our first segment, and what a great way to kick off the show with James Wright, the Chief Investment Officer from JBWere, and also Frank Casarotti from Magellan. It's going to be a great night. We're here live at the Australian Stockbrokers Awards. Now, because we are filming from the event, you won't be able to call in, but we will go through your emails, and we've got your second segment coming up next with panellists talking about some individual stocks, so stay with us. Welcome back to this special edition of Your Money, Your Call from the Australian Stockbrokers Awards. I'm Julia Lee from Bell Direct, and in this second segment we're talking about individual stocks and we're taking your emails. So the phone lines are closed. Joining me in this second segment we have Matt Felsman from APP Securities and also Chris Conway from Ascot Securities. So a pleasure to have you in this second segment. We've got plenty of emails to get through, so let's go to our first email. And this one's from Alistair in Adelaide. And he's asking about Flight Centre. Now, this has been a bit of a funny stock over the years, down, up, but it seems to be on the up and away at the moment. And he wants to know about the movement of this stock, especially in the short term. So, Chris, looking at Flight Centre, what do you think?
Sure, Julia. Well, I'm a little bit like you. I don't mind looking at technicals as well as fundamentals. And I saw the close on Flight Centre today and actually managed to close above a pretty important resistance region around 37.50 or 38, I think. So technically it's quite strong, but I can't escape the fact that the last couple of times it's reported, it has reported quite poorly. There's a lot of competition in the space, and that's driving down, obviously, ticket sale prices and crimping Flight Centre's margins. So I'm a little bit torn on this one. I do like the technicals, and as I said, it looks reasonably strong, but fundamentally, there's some red flags.
I have to admit, I'm with you there. I actually hold this one in my portfolio, and it's been rising and rising. And it's hard to look at the fundamentals because so many times it's come out with a shock to the downside when it's come out with earnings. But, you know, the momentum does seem to be there at the moment. Matt, what's your view on Flight Centre?
I think the ideal time to have owned it would probably, if you could pick a time, would have been from 2009 to 2014. In those 5 years, the stock went from $5 to $55. So, I mean, you could argue the best is behind the stock based on where it's trading now. And there's so much divergence between where analysts and broking houses and at investment banks, where they actually value the company's share price. It ranges from $25 to $36. So it might be in the bit of the too hard basket for me. If I owned it, I'd probably be more inclined to sell it as it's closer to the higher valuations. And if I didn't own it, I probably wouldn't be buying it.
Okay.
The stock's put on 15% in the last 12 months, and the big thing for me, and this will probably direct the share price movement over the next sort of short term, or based on what the question was short interest. The short sellers in this stock have put on, I think, accelerated by 30% in the last 3 months. So it's the 10th most shorted stock on the ASX. It's probably higher end valuations for me. And it's a little bit hard to put your finger on. No one's got a real high conviction that I can kind of agree with.
Okay, so putting you both on the spot here, when we look at some of those tourism holiday type of companies like Mantra, Ardent Leisure, Village Roadshow, Qantas, Virgin, and even a stock like this, Flight Centre, there's a huge divergence. You can even throw in corporate travel into the mix as well. In terms of performance, they're either great performers or they're terrible performers. What's your view on this sector? Do you have a favourite stock amongst some of those ones, Matt? What do you think?
Look, I think it's... depending on the currency moves and depending on some of these key areas, it could be a stock that comes back into focus. There has been a lot of stocks that have disappointed of late. Mantra is a great example. One we hold that we're actually quite positive on is not quite in the sector, but is in leisure, and that's Aristocrat Leisure, ALL. Which has just enjoyed a nice little upgrade cycle. So we're letting that run out at the moment.
Always nice when you've got earnings momentum and price momentum happening, as Aristocrat Leisure does. How about you, Chris?
Yeah, in terms of the tourism story, I think Webjet would be my preference over Flight Centre. And another stock I like, it is a bond proxy, but Sydney Airports as well. I don't mind that exposure, and again, it's tied to the Chinese or the strong tourism from China and the strong tourism numbers or the strong passenger numbers they've had recently. So they'd probably be my two on this theme, I guess you'd say.
Okay, it's time for our second email, and our second email is about Brambles. It's been moving sideways of late. Is there upside for this stock? And Matt, you mentioned currency movements, and Brambles one of those ones that tends to be swayed along with where the currency is going. Given where the Aussie dollar is and the outlook for the Aussie dollar, what's your outlook on Brambles?
Well, when I think Brambles and sideways movements, I think it has traded from $9.50 to $10.50 in the last, since about April. But the thing that stands, I don't own it. The thing that stands out for me is the big downgrade we saw at the start of the year, where it went from, this time last year the stock was at $13.60-ish. Its all-time high is about $13.80. So I would argue there's probably more inclined to. It's not trading sideways. It's on the way to further declines. I don't know. I don't feel they've addressed some of the concerns that were raised. A big thing for me that I can't get my head around is every week we hear the word Amazon now and digital disruption, and people are no longer going into the stores to take things off the shelves that were delivered to the stores on a crate built by someone like Brambles. So I think I'd really need to hear a positive corporate investment case on that area. And maybe some of their business in the US that they raise some of their flags with. I think there's a lot of room for disappointment here. One other point I will just mention is that people have actually started to short this stock now. So there was no one was short in January, and now there's about, I think, 1.5% of the registers short. So it might be the next Amazon short, death by Amazon type trade.
I mean, a couple of good points by Matt. Firstly is that, once we see a downgrade, usually that's the start of a cycle. So do you think Brambles is in this downgrade cycle? And secondly, usually with the sideways movements, the longer it goes on for, the more severe the breakout. Do you think it's going to be to the upside, or are you with Matt? It's going to be to the downside.
I'm definitely with Matt on this one. I'm definitely a firm sell on Brambles. As Matt pointed out, there was the downgrade, but that was followed up again about a month later with the actual results, and it fell again. The price action has recovered to that initial breakdown point, but it looks as though it's beginning to roll over once again. And just in terms of the consensus estimates are suggesting revenue growth of about 10% in the fourth quarter. The year-to-date growth is about 5%. So they need to pedal very hard in the last quarter to make up that difference. I don't think they can. So I think it's setting up the situation where they miss again and probably another big belting on a downgrade.
Doesn't sound good for Flight Centre. Sideways movement at the moment, but both our panellists seeing a breakout to the downside for this particular stock. And finally, we have QBE, looking at short to medium term movements from here. Now, we know that earlier we did see QBE coming out with a profit downgrade because of some of its claims in emerging markets. However, is this an opportunity for investors and traders, or is this one you should avoid? The macro factors seem to be moving in QBE's favour. Chris, what do you think here?
Yes, I'll take this one from a purely trading perspective. It did actually put in a nice pin bar today, so a pretty strong reversal candle. I think there was 4 brokers that came out today, Macquarie, Morgan Stanley, and I think UBS reiterating their buy with price targets sort of 13.50. You're right, there are some macro factors that should help it in terms of rising US interest rates. So yeah, for a short-term trade, I would be happy to take a punt on this one. Have a pretty tight stop, I reckon, because if it does go south, you don't want to be holding as it craters. But I think, there's a bit of upside in this one.
Okay, so liking QB, I mean, it's an interesting one because the macro factors do play a big part. And while we have seen US interest rates rising, we've seen sort of that high yield trade back in focus because of what we've seen in terms of bond movements. So QB insurance, short term, what do you think, Matt?
I think, when a stock gets downgraded, it usually takes a little bit to play out. So if you want to look short term, I think there's more downside ahead. As price targets come down, models are revised.
But when you see the brokers coming out with buys, despite the downgrade, what do you think?
Well, the stock's put on, in the last 6 months, it's gone from $9 to $13.50. So that's 50%. If you hear the word downgrade, do you need an excuse to lock that in? I mean, I think it's, if you want to buy the stock, you can wait a little bit longer. And if you hold the stock, you might wait for a little bit more guidance that they're going to be giving in August on their full year results. What you have to determine is whether this is, it's the best type of downgrade to have if you're an insurance company, a one-off weather event that's got nothing to do with management, or are they, as a turnaround story, hit a snag? Is this typical QBE disappointing investors? And it's a bit hard to tell right now, but I'd be waiting if I owned it, and also if I wanted to buy it. I think short term, might see some further movements downward, but we need to figure out whether this is a one-off or it's more of a longer-term thing.
Okay, it's a good point. QBE hasn't had such a great track record in terms of surprising the market on the upside when it comes out with its results. So I guess our panellists a little bit dour in terms of QBE and maybe waiting for those August results to get a bit more of an outlook, although Chris is a bit more positive in terms of
Just as a trade.
Short-term trade in terms of the technicals, and pointing out that the brokers are pretty positive as well. We don't have a lot of time left, in fact just a minute left, but Chris, I'm going to put you on the spot.
Sure.
Our viewers often like some ideas in terms of stock portfolios. So in terms of a tip perhaps, or a favourite stock that you're watching at the moment?
Yeah, so there's 2 I really like at the moment. One is Macquarie Group and the other is Transurban. Transurban, they have their I-395 toll road. They've just released some projections for in the US. I think they're a little bit conservative, so there is a possible beat there. And if Trump does get his infrastructure plan off the ground, there might be some state toll roads that they can buy as well and snap up at a good price and become turn more profitable. So, like TCL, on the Macquarie side, I really just like the way they run their business now, an annuity-style business that generates most of their profits from their infrastructure assets. So, yeah.
And we've run out of time for that second segment. As the clock ticks down for the Stockbrokers Awards, the industry's night of nights, we've had a fantastic second segment, and we've had Chris Conway from Ascot Securities as well as Matt Felsman from APP Securities. Our next segment will be the Exchange Traded Fund segment. There's plenty of new products, so let's find out the outlook for some asset classes as well as some of those new exciting products out there on the market. We're going to go to a very short break. Stay with us. Back to this special edition of Your Money, Your Call from the Australian Stockbrokers Awards. We have a special panel for you looking especially at exchange-traded funds. And on the panel, we have Kanish Chur from ETF Securities, Tim Sparks from Vanguard, and also Pete Harper from Beta Shares. Now, we've got lots of questions that have come in, so let's get straight into it. The first email in is talking about Europe. Europe has made headlines over the last 12 months. What's your view on Europe, and why is exposure to Europe so low in Australian portfolios? Kanish, we might start off with you.
Yeah, so I think Europe had a lot of geopolitical risk more recently, given with the French election, the Italian election, we had really from Brexit from last year, and I think a lot of that has started to dissipate, and what we want clients to really look at is look at the underlying fundamentals of Europe. So actually see what is driving Europe's growth. Now, Europe had a growth of about 1.9% to the March quarter. Its expected growth for next year is about 1.8%, and that's what we really are trying to look at, seeing what the ECB have done and saying what are the fundamentals, and maybe that's where potentially it could be, some value.
So do you
there.
like Europe, Kanish?
For us, we do. We also coincidentally launched a European equities product in July of last year, which is the Eurostoxx 50 ETF. So that is sort of one of the prominent benchmarks covering Europe. It's core Europe, so no UK exposure or Switzerland or Nordic. So it's just pure 50 largest stocks from the European region. And for us, that's probably one where if clients do want Europe, that's where we see it. And on your second question, why do clients sort of underrepresented in their portfolios in Europe? Two reasons. I think lack of options. I think in the past 12 to 18 months we've seen from my peers as well the launch of European equity products where previously there has only been maybe one incumbent. Secondly, I think also it's probably a lack of understanding and awareness. A lot of people might gain Europe through just a pure global broad exposure.
Okay. Pete, looking at Europe, are you positive on Europe, or do you prefer somewhere else in terms of exposure in portfolios, and where do you view European markets going? And with an ETF like Kanish mentioned, is it heavy exposure to basically the banking space as we do see in other markets?
Sure. When we look at Europe, we do like Europe at the moment. We see Europe as being, approximately 4 years behind the US recovery. So, with potentially a bit more growth from here relative to the US market, for example. We also like the valuations in markets like Europe and Japan more than we like the valuations in the US. You're seeing them trading on a PE discount that's relatively substantial in a historic sense to the US market. So we definitely think that Europe is a place people should be looking, and Japan also. In terms of what you're getting exposure to, look, it varies from fund to fund. Kanish can probably talk about the sector exposures in the Eurostoxx 50. Our European equity exposure is a bit different in that it's currency hedged and it's tilted towards exporters. And why we think that's important is if you look at the historical correlation between the euro and European equities, they historically move in opposite directions. So if you're holding European equities and you're not currency hedged, then historically what you've made on the equities, you've often lost on the currency. So we look to eliminate that risk in our exposure, and we also look to focus on exporters, because generally when the euro is falling, that's when the shares do well, and the companies that do best are those that export into markets outside of Europe.
Tim, it's always hard going last, but what's your view on European markets? And, some good points in terms of currency moves as well. So how does currency play into your view on Europe at the moment?
Europe, it's certainly been interesting over the last 12 months, there's no doubt about that. I think that Brexit was a good lesson in potentially not reacting to short-term market movements. And so when Brexit was announced, European equities went down. 3 weeks later they were about the same, and now they're up. And so I think that taught us to maintain a focus on your long-term investment objectives. We tend to look at Europe in the context of an international equity portfolio, and so if you've got Europe and you've got the Asia-Pac region, you've got the US, using Europe in combination builds out international equities, and investors can certainly dial up and dial down particular exposures. There's no doubt about that if they want to implement a particular point of view. But we have had a lot of interest in European equities, certainly since March, and most of that's based on performance. And so there is a way that you can play that, VAE, V for Vanguard, VEEQ, V for Vanguard, E for equities, and Q for Quick, building out 1,300 European stocks across 14 European countries, and I think that complements an Australian equity portfolio really well.
Yeah, it's quite interesting talking about Europe because we do see the US making so many headlines with the US indices making record highs daily, if not weekly. But it looks like Europe, the outlook's looking pretty good at the moment, which brings us to our second question. And this is one that is quite topical. And the second email is around the tech sector. It has been very popular, especially in the US. And I guess the big question is, have you missed the boat if you're not in here already? Has the sector already run its course? And how do you gain exposure to tech? Is it purely through a US stock index, or can you gain exposure to that sector? Tim, we might start off with you this time.
Yeah, sure. Again, I think it's in the context of a broader exposure. If you look at the US market, that's a trade that's gone really well over the last 2 years. If you've been bullish US equities, bearish the Aussie dollar versus the US dollar, it's gone well in portfolios. Building out geek sectors that are poorly represented on the Australian market, and IT is certainly one of them. If you invest in broad market US equities, 18% of that market is tech stocks, and that's the way that we see that getting played. If you overweight a particular sector, you'll get a result that's different, and so you'll get a result that sometimes it's better and sometimes it's worse. But having a foundation of every sector, tech being one of them, in the US market has been very popular with investors.
I mean, the tech sector, have we missed the boat? You know, you've got Facebook, you've got Apple, you've got Twitter, Amazon, all in the news and all performing pretty well. What's your view on the tech sector, Pete?
Yeah, look, I mean, first of all, when we look at the US market, I think most would agree it's fairly fully valued. But the key point is, if you look at the PEs on, something like Nasdaq versus, which is obviously fairly heavy in tech, versus S&P 500 or MSCI World or any of those exposures, they're broadly trading on the same PE multiple. So they might all be expensive, but none are really any more expensive than the others. So if you're going to make an investment into that sort of space, the next thing you probably look at is the earnings. And you look at something like the Nasdaq index, and you're getting 3 times the earnings growth of the S&P 500. So if I was going to make an investment into one of 3 things that are all roughly the same PE, I'd probably go for the one that offers the greatest growth prospects. And you've seen that in the PE of Nasdaq. It's actually declined 15% over the last 10 years. So it's actually getting cheaper, as opposed to S&P 500, MSCI World, which are getting more expensive over the last 10 years or so. Okay,
so the growth has been pretty strong for these tech companies. You don't think they've reached some point of saturation or close to reaching saturation in terms of those growth rates?
Look, it depends on what you look at, and I suppose there's a couple of things to consider there. So, first of all, you look at somewhere like cybersecurity, which is a sub-segment of tech, and we've got an ETF on that, ticker HACK. The revenue growth in cybersecurity is sitting at about 60% per annum over the last 3 years, relative to just broader IT and tech, which is sitting at about 30% per annum. So you're seeing almost double the revenue growth in those segments, and tech itself is ahead of the revenue growth in the S&P 500 and broad market. So, we still think that revenue growth, as long as they keep costs under control, can lead to strong earnings. And you see other areas, companies like Amazon, which are only accessible in broader indices like Nasdaq, and they're now investing in their business all the time and driving that growth. So we think that can provide good outcomes for investors into the future.
Okay, so the growth is there, even though the valuations are pretty lofty. Kanish, what's your view on the tech space?
Look, I think I agree with both Tim and Pete in terms of the bubble is not what it seems to be. I think it's more media noise. I think there is potentially quite a bit of growth in that tech sector. obviously the drivers of the tech sector has been cybersecurity, automation, cloud computers, cloud software, etc. And what we also see is a bit of a demographic trend, in terms of emerging markets. And as those emerging markets start to pick up, you start to see tech companies start to flourish. So for us, we launched a global tech ETF in April of this year. So tech being the code. For us, we want to take a view of not just looking at the US, we want to take it as a global view. So
sorry, you mentioned demographics and how that drives some of your view on the tech space. The demographics sort of in developed countries, we're seeing aging demographics. So you're saying in the emerging countries that the younger demographics is a positive for the tech sector?
It's a combination. So if you look at something like the demographics in the emerging market, where you have the younger generation coming in using quite a bit of the technology, whether it's phones or computers, software, etc. But then you also have on the aging demographic side the use of technology in a whole range of spaces, whether it be medical, aged care facilities, nursing homes, etc. So that's where, for us, the tech sector is not just purely looking at what it may have been 50 years ago, which is purely looking at a single product. A lot of what Apple does, what Facebook do, or Google, Alphabet do, transcends a lot of that. And so for us, we took a view of taking as a global view. So tracking a Morningstar index, which looks at using their moat strategy, so looking at stocks that have a sustainable competitive advantage in the long term, looking at a valuation screen in that. So, taking it as a global view rather than just saying, well, just the US on that.
So, the tech space has been a pretty interesting space and pretty lofty valuations, but as our panellists mentioned, the growth rates do seem to be there as well. So the big question is whether that can hold up. Final email is a pretty interesting one, I think, and that's that there's lots of interesting products in terms of exchange-traded funds, your favourite. Now, I know that we could probably talk for a few hours about this one, but we only have a few minutes left here, and I have to mention that, I've used all of your products. I've used the Bear ETF from BetaShares, and I guess starting off with you, Pete, I didn't know that there was a geared Bear one. So there's a plethora of products at the moment, and seeing three people in the industry, it would be quite interesting to find out what your favourite products were. So, Pete, we'll start off with you.
Yeah, look, I don't want to rehash old ground, but my favourite at the moment is NASDAQ, and not just because of the growth in that index, but we're actually looking at the diversification. So if you look at the Aussie market, the two sectors you're most overweight are financials and resources. They have a zero weighting in the NASDAQ index. If you then look at what you're most underweight in Australia, it's tech, consumer discretionary and healthcare. And guess what? They're the three most overweight sectors in NASDAQ. So you put that together and they're global companies earning revenue streams all over the world, but with a much better sector blend when combined with an Aussie share portfolio. And we think that's a great way to get international diversification for an Aussie investor. Probably the one other thing where we're seeing good flow at the moment is just our recently launched floating rate bond fund, ticker on that one QPON, Coupon. And many investors, want to have the security of a fixed income investment and the stability that offers, but are starting to worry about rising rates around the world. And as many people know, obviously in rising interest rate environments, fixed coupon bonds tend to fall in value. And you can avoid that with a floating rate bond, and that's now available on the ASX. Okay,
so a couple of great ideas there. Tim, how about you? Do you have a favourite ETF?
I wouldn't say a favourite. I do. The favourite thing for me is the benefits that they bring to investment portfolios. So something that's driven the category around cost-effective, transparent, liquid, diversified exposure. Whenever you get a successful product set, you'll get product proliferation. But I think it's also important to remember that sometimes simplicity doesn't come with a lack of sophistication. And so if you can build out an exchange-traded fund portfolio, 7 trades on the ASX, over access to over 10,000 stocks and bonds across 40 developed and emerging market economies. It's a pretty good result for investors. That said, since the 1st of January, year-on-year performance to date, Asian region equities is something that's there's a lot of interest with our clients and investors, and so up 16% from January 1. Stock code on that one's VAE
And does that have anything to do with China recently being added to the MSCI Emerging Markets Index? It's only a little bit, 0.7%, but you know it's a start. And ETFs are growing quite quickly, so I suspect that will mean more fund flow into the Chinese market.
They are. China is an exposure in that. There's no doubt about it. But there's also broader exposure across 10 Asian region countries, and so it gives investors an opportunity to diversify out of just an overexposure to Australian equities, and we're seeing that as a fairly popular ETF and implementation vehicle at the moment.
I mean, Kanish, we're seeing this area absolutely exploding, whether it's smart ETFs or commodity-based or even fixed interest. What's your favourite one?
Look, choosing a favourite one is like choosing your favourite child. You probably don't have a favourite one.
Everyone has one, right?
That's true. But where we've seen flows of late has been in the European equity product of ours, so ESTX, or our tech sector, so tech being the code, but also in our US equity product, which is a rules-based approach. So some might call it smart beta, some might call it factor-based. Essentially, it's an alternative rules-based index that we track from S&P, and it looks at yield and volatility. So current yield is about 4.2%. Now, to take that into consideration, the average ASX 200 might have a yield of about 4.5, 4.4% at present. So obviously, there's no franking credits within US equities, but for us, with clients wanting diversification into income, that's where we see, so ZYUS being the code for that.
Okay, so that's our third segment. Plenty of ideas there, especially in terms of European equities, Asian equities, and some of those newer products out there as well. So hopefully you've picked up some ideas from our three panellists, Kanish Cho from ETF Securities, Tim Sparks from Vanguard, and Pete Harper from BetaShares. We're going to go to a short break. Stay with us. Welcome back to this last segment of Your Money, Your Call from the Australian Stockbrokers Awards. Joining me on this final panel, we have Matthew Haupt from Wilson Asset Management and also Andrew Bowe from Antipodes. Now, I guess in this final segment, we'll be looking at both domestic Australian stocks as well as international investing, because Antipodes looks at the international side of things. But first, let's start off domestically. The first email that we have is on Woolworths, the outlook for Woolworths, and it's especially relevant given that we have seen Woolworths under pressure, Matt. We've seen the fear of Amazon sort of coming into the Australian market. We've seen Amazon taking over Whole Foods and possibly disruption in that grocery space for Woolies and some of the other players in this area. When you look at Woolies, do you see just or downside? And I guess I expanded out to something like Metcash as well. Is there a takeover potential there if Amazon does decide to come in? And what's your outlook on Woolies?
We're really positive on Woolworths. I think the outlook is really good for them. I expect them to do over 5% comps for the financial year. And I think we'll get operating leverage in 17, 18 and 19 eventually. So I'm quite positive on Woolworths. When you look at Amazon, I mean, Amazon's strategy has been a failure so far. They have 0.2% market share in the US. This move to bricks and mortar just shows you the change of strategy. And I think for Australians to sell off Woolworths on the back of the Whole Foods acquisition is a little bit illogical. I mean, Walmart is going to be standing between us and Amazon. So Walmart have 4,500 stores. Whole Foods has 450 stores. Walmart's $230 billion market cap. So they'll be fighting really, really hard to stop Amazon in their domestic market. So to put that into the Australian market right now, I think it's a little bit too early to say that it's going to have an impact, especially on Woolworths. When you look at Metcash as a takeover target, it's a little bit harder because the way their franchise model works, to get control of the stores and the network would be a bit harder, but the distribution channel, I guess, would be quite good for Amazon. But I think the model doesn't really fit the way Amazon do business.
I mean, Matt has a really good point that, you know, the momentum in terms of Woolies does seem to be intensifying and gathering momentum compared to Coles. But of course, the international example, whether we look at the UK or the US, looking at the Tesco's of the world in the UK or in the US, a lot of the retailers, we've seen a lot of examples there where we have seen disruption coming through. So I guess just having a look at the international space and retailing, you know, what's your outlook for consumer staples retailers?
I mean, I've just come back from the US after a 2-week trip and just meeting a lot of those retail companies over there and chatting to investors and brokers, you just get the sense that for many of them now, they're classifying retail as uninvestable because of that online onslaught that's coming, mainly from Amazon. But yeah, I saw that as a great opportunity because not every retailer in the US is going to die and roll over for Amazon. So the way they're getting priced at the moment, some of them are offering, I think, pretty good opportunities for us to be able to get involved with. But the acquisition from Amazon is fascinating because they've been experimenting with Amazon Fresh for over 10 years now, trying to work out how do they access that fresh food category. And to their credit, those tests have become very high quality now in terms of being able to deliver to the customer in a short period of time, using stores that basically have no touch points or people involved. So you can see if they can apply that distribution model now to an existing infrastructure base like Whole Foods that is national, you can see why the attraction is there for Amazon, and many others are fearful, can Amazon get a lot bigger more quickly? But as Matt pointed out, it's still got a long way to go to take on the might of Walmart and Co.
Okay, so some interesting viewpoints there. Perhaps, the market's jumped the ship too early when it comes to some of these consumer staple stocks such as Woolies. And as Matt pointed out, some of the comparable sales growth has been quite strong in terms of Woolworths and Amazon. Perhaps, it might be a bit of a rocky ride there in terms of that retailing space. We do have our second email for you, and this one looks at China being included into the MSCI Emerging Markets Index. What's the impact that will have on China as well as perhaps the Australian market, and what's your view on emerging markets versus the rest of the world? And this is probably a good one to start off with you, Andrew.
Well, we think China getting included now in the emerging market MSCI is great because a proportion of our portfolio is already exposed to China. So it should be good for the Chinese market and also the Chinese economy because now that's going to open up a new channel of capital to flow into China, which should be good. The regulators in China have been working hard on getting that door open over the last few years. Now it is opened. Yes, there are risks remaining concerning transparency, corporate governance in China. They've been the big concerns for international investors.
They're pretty big concerns.
They're big, but hey, we can find stocks in there that can help allay many of those concerns. That's what you've got to do. You've got to find the value versus the risk. And we think now that more Westerners will become involved, they're going to provide more insight and hold more of those Chinese companies to account and improve that corporate governance, hopefully to then accelerate positive change that's already underway.
I mean, Matt, I've heard some fund managers call China uninvestable. But, it has been a growth engine of the world. Whether we look at it driving Australian growth and some of the stocks over here, how do you view China, and are there any stocks that you're positive on here in Australia that have exposure to China, probably mainly those commodity-based stocks?
Yeah, it's generally the way we play as a domestic manager. China is through commodity stocks. There's a few retail stocks you can play if you game through the infant formula traffickers, you could call them. But yeah, the predominant way you play it is through the resources, and at the moment they've had a really big sell-off. It's really hard to see them recovering from here, given that the infrastructure and property is a little bit under pressure in China at the moment. But I agree with Andrew, the MSCI rebalance is fantastic for China, and hopefully it will accelerate market reform and governance, which will be a great positive for the region in totality. Probably a slight negative for Australia with the rebalancing over time, but probably not. The overall positive probably outweighs the negative.
Okay, so interesting moves there in terms of China being included in that index. I think they've tried 3 times and they've finally
I think
managed.
It's the 4th year they've tried and now they've
succeeded.
Yeah.
So 0.7% from May next year, and slowly, hopefully, that we'll see that increase.
Yeah.
The next email is about QBE insurance. We've seen QBE in the news. What's your longer term views on QBE? Do you like it? Would you be avoiding it? What do you think, Matt?
QBE, they never fail to surprise you. Almost got to June 30 without a surprise, but another left field event. The overall result was actually pretty good. The core business was performing well, investment income was up, but a few left field events. So just trying to work out if they're one-offs. Obviously the weather is a one-off, but the other issue is the legacy issue in LATAM concerns me a little bit. Haven't got to the sort of uncovered what the detail is yet. But I think the core business over time should do well in this environment. If interest rates keep going up, they'll do well. And if liquidity is taken out of the system, reinsurance rates will slowly push up as well. So I think over time, if you can stand the shocks, QBE should perform quite well.
Okay, so, I mean, Matt, you mentioned interest rates going up, and I guess I'll bring you into this one, Andrew.
Yeah.
The expectation is that interest rates in the US will rise. That seems to be the consensus. But a growing sort of voice seems to be, is the US going to be able to increase rates, as aggressively as the market is thinking? Some of the data points that we have seen out of the US haven't been so rosy and so positive. And you've just come back from the US. So what's your view on interest rates and how they impact on portfolios?
Well, I think already that view is starting to get pushed out again. Maybe it's 2, maybe it's 1 this year rather than what had previously been 3 or 4, I think. But generally, the mood in America is quite strong, quite good amongst the corporates. I was surprised at how much little attention they gave towards Trump and his potential impact. Companies are just getting on with it and ignoring Trump. If Trump gets some of his policies through, they're saying, great, that's going to be good for business, but we're certainly not relying on it. So generally, the mood's pretty good.
So things are pretty good there in terms of interest rates. And just quickly, we've only got a minute left on the show, but favourite investment at the moment or favourite stock?
I've got to say it's Hyundai Motor in Korea because that is Antipodes Partners' largest position. That's a business or a brand that's gone from zero 20 years ago to something that's now quite impressive. Like 20 years ago they were making tin pot cars. Now they're making quality cars, value for money. And we can pick that up at half the valuation of what we'd pay for its global peers like a Ford or a General Motors. Strong balance sheet and corporate governance is changing, so we like the potential in that stock.
Okay, so an unusual one there, Hyundai over in South Korea.
Yeah.
And Matt, any tips or favourite stocks you're looking at the moment?
I have to go with Woolworths, being our largest holder in WAM Leaders. So I think you'll get over $30 in this stock over time. This operating leverage I talked about will come through. They should print a good sales number, and we're just at the start of the turnaround. We're not midway through or near the end, we're just at the start. So I think that operating leverage will come through and should drive the share price higher.
Thank you so much. That brings us to the end of our show. In our last segment, we had Matt Haupt from Wilson Asset Management and also Andrew Boyd from Antipodes. Thank you so much for joining us. Here we are at the Australian Stockbrokers Awards. The awards are just about to kick off behind me. This is the night where we celebrate the industry's best and also raise funds for charity. Thank you so much for joining us for this special edition of Your Money, Your Call from the Australian Stockbrokers Awards. I'm Julia Lee from Bell Direct. Have a great night.